What's going on, guys? Welcome back to Broke Man Finance. I am super pumped about today's video because we're not just covering one penny stock company, we're not covering two penny stocks, but we're covering three penny stock companies that have some serious potential to continue to grow over the next couple years and to hopefully grow your portfolio as well. Now stick around to the end of the video because one of these companies just announced that at the end of the month they're going to do a reverse stock split, so that definitely could affect your decision on whether you're going to buy or not buy into one of these companies. And the only thing we ask that you do is hit that like and or subscribe button to help the channel out so we can continue to push out good quality videos like these. So the first company we're looking at is ZooMedica, or ticker symbol ZOM. Now, if you're not aware, ZooMedica is a development stage vet diagnostic and pharmaceutical company. And be honest with you, their stock has seen an impressive increase just this past year, going from a few pennies per share to at one point over $2, and right now it's trading under $1 a share. Now, it's important to note that as of mid-March, ZooMedica is no longer a pre-revenue company. In basic terms, that means they are finally making money and bringing in revenue, which is a great sign for this company moving forward. Now, recently, the company announced that its commercial launch of its diagnostic tool, TRUFORMA, providing speculators with some potential data with which to consider buying the stock. This commercial launch also aligned with a distribution partnership with Miller Vet Supply. So in other words, it appears the ducks are all in row for investors to start taking ZooMedica very seriously. So from here, revenue growth is going to be the biggest key factor or metric that we look at for this company. TRUFORMA has a lot of potential. There's a huge market for it as long as people start buying in and all these vets say, hey, this is a quality product we can use. This company has a lot of room for some serious growth moving forward. Now, if Americans love one thing, that is their pets and how we take care of our pets. We are projected to spend over $99 billion this year alone on them, putting companies like ZooMedica in a fabulous position to keep increasing their revenue growth. Now, while they still have a lot of challenges, as with any newer company moving forward, a lot of unseen obstacles I'm sure awaits them in the future, the truth is they are in a position to bring in a lot of revenue just off this one product alone. And as they develop other products, they are in a tremendous position to really grow as a company, and in return, help grow that stock for us investors. Now, another penny stock we're talking about that we have already covered on this channel before is Castor Maritime, or ticker symbol CTRM, which is trading under $5 a share right now. When you look at CTRM, they have seen an interesting price movement just over the past year, increasing from a share price of just 12 cents to nearly $2. If we look at CTRM's past chart, it kind of gives an insight to where Castor Maritime could be headed in the next couple months to the next couple years. And when we talk about where they're headed, let's simply look at revenue growth. Now, I'll look at these numbers, be honest with you guys, this makes me super excited when I look at a company that has grown so much far as how much revenue they've brought in. So for the first 3 months that ended in March 31st of this year, they brought in over $7 million of revenue. When we compare that to the first 3 months that ended in March 31st of 2020, they had only brought in $2.7 million of revenue. So what does that equal? 159% increase from period to period. If you look a little deeper into their financials, you look at net loss and earnings per share, and Castor has seen a 180 from the March of last year. They are now turning a profit and now have provided a positive earnings per share as compared to a loss per share at this time last year. Of course, we look at last year as a global shipping company, CTRM saw a direct negative result from the effects of the pandemic. This impacted the ability for it to import and export goods, a cornerstone, obviously, of this type of business. Yet now, if we look at international trade concerns, it's not as a hot topic as it was a couple years ago. CTRM is in a fantastic position, and they're looking at a best case scenario moving forward for the company as well as investors. With a recent announcement of its plan to acquire a 2013 Japanese-built dry bulk carrier for nearly $21 million, they are showing us that it's readying itself for the future. Now, according to their website, after this recent acquisition, they will now have over 24 vessels in their fleet overall. So for me, a key factor when I look at this company is debt. Obviously, the more they acquire and the more they grow, they are going to accumulate more debt. However, as long as that revenue growth is growing like we saw in this first quarter, and they have a proactive and a solid plan to address that debt moving forward as a company. I mean, every company has debt, so this isn't a big concern, but sometimes companies tend to grow a little faster than they're really designed for, and they can kind of bring in a lot more debt than they want to. So look at this as you think about investing to this company, the debt to earnings. Look at how much debt they have, their revenue growth, and how much they're paying down debt each quarter is going to be a big factor on how successful this company can be and how this growth or how the stock can really grow in the next couple of years. And then the last company we're going to talk about is Ashford Hospitality Trust, or ticker symbol AHT. Now, when it comes to this stock, this is probably the riskiest stock of all three of these. There's a lot of risk and there's a lot of speculation concerning this company. To put it in perspective, AHT is a real estate investment trust, or a REIT or RET, depending on how you pronounce it, that owns over 102 upscale hotels. Now, when you look at these hotels, they have a very diverse portfolio of the different brands. They have Hiltons, they have the Courtyard Marriott, the Sheratons, the Westins, and they're all over the United States. So it's not just one particular region, which definitely helps the company moving forward. Of course, they took a major hit when the COVID-19 pandemic hit the travel industry. No one was traveling, not as many people stay in the hotels. So it affected them in a very negative way as far as revenue. So right now they're trading right around $6 a share, just above the penny stock line, if you will. But I thought it was good for this video because it kind of gives a actual balance when we compare these different penny stocks. Now, if you look at the graph, you notice back in 2020, they were trading a lot higher, but they conducted a reverse stock split, which as a result dropped that share price as you see on the graph. The key factors as well this company is look at is debt and earnings. Obviously, we know we're starting to get out of the COVID-19 era where everything was shut down. So as long as they have a proactive plan moving forward to address this debt, and as revenue increases, this is a stock that has a lot of upside in the next couple months to the next couple years. And when we look at those financials, the REIT took several steps in the recent months to help strengthen its balance sheet. It secured forbearance agreements for up to $3.6 billion of loans and exchanged $325 million of preferred equity for common shares, which these moves enhance its financial flexibility. That really puts them in a stronger position to benefit from improvements in leisure travel. As mentioned before, the pandemic subsides in the United States. Although this stock is 50% below its pre-pandemic value, which could indicate to some investors it still has a lot of room to increase over the next couple months if everything continues as planned. So the big question you have to ask yourself, looking at all three of these stocks, is does it fit into your portfolio? Remember, I am not your financial advisor. I'm not a certified financial advisor at all. So please do your own research or reach out to your own certified financial advisor before you start investing in companies like these that have a lot more risk than other stable companies. And as mentioned in the beginning, we're going to talk about the company with the reverse stock split. And that is Castor Maritime, which announced that earlier this month that they will be doing a 10-for-1 reverse split effective on Friday, May 28th. This means if someone holding, let's say, 1,000 shares at 40 cents, each will now own 100 shares at $4 after this split is effected. Now, the big reason they're doing this is to stay listed on the NASDAQ. The NASDAQ has certain requirements, and one of those is for them to stay over $1 a share. But a key thing to look at this is typically when people do reverse stock splits, or not say people, but companies do reverse stock splits, it attracts short sellers. So be kind of cautious on this if you're looking to invest in this company or add more to it, because the whole thing with the short sellers, maybe this turns into another retail investor stock like AMC or BlackBerry and it shoots up and it doesn't affect us at all. But it is a piece of caution to warn you with that if historically people tend to gravitate toward these companies as short sellers if they do a reverse stock split. That's it for me today, guys. Thanks for watching. Thank you for supporting the channel. I hope you stay safe, and we'll see you on the next video.